Welcome back to Candlestick Signals for today's market, September 15th, 2025. Buckle up because we're in for a wild ride. The market opened with light momentum, but don't let that fool you. We were seeing increased volatility as participants position themselves for the upcoming FOMC rate decision and contract rolls later this week. Let us dive into the candlestick signals that are lighting up our charts and shaping today's trading landscape. Our candlestick structure analysis reveals some fascinating patterns across major indices and sectors. We've identified 416 instances of doji and near doji formations, highlighting broad indecision, especially in financials and utilities. These patterns suggest that traders are holding their breath, waiting for the next big move. But that's not all, folks. We're seeing a staggering 493 hanging man patterns with a high concentration in utilities and energy. This bearish reversal signal at recent tops is waving a red flag for these sectors. It's time to keep a close eye on your energy and utility holdings. The bearish Harami pattern is dominating the landscape with 887 instances, indicating caution and potential reversal, mostly in high-cap industries. This pattern is like a stop sign for bulls, warning of possible trend changes ahead. In the energy and large-cap sectors, we've spotted 268 bearish engulfing patterns. This formation is screaming further downside risk, so traders in these areas should be on high alert. But it's not all doom and gloom out there. We've identified 71 bullish engulfing patterns, predominantly in technology and small caps. This suggests there are upside opportunities at recent lows for those willing to take calculated risks. Lastly, we've got 31 hammer formations emerging in financials and select consumer sectors. These bullish reversal signals are hinting at potential rebounds in those pockets of the market. Now let's break down the sector performance and technical interpretation. As volatility heightened, we observed clear signals of sector rotation. Utility and energy stocks, which are top-heavy in market capitalization, exhibited a dominance of hanging man and bearish Harami patterns. These are strongly bearish signals at elevated price levels, suggesting potential pullbacks in these sectors. On the flip side, technology and communications sectors, favored by retail momentum, displayed constructive bullish engulfing and occasional hammer formations. These patterns are indicating reversals and potential entry opportunities for savvy traders. When it comes to chart duration, intraday signals predominantly leverage the 15-minute and 30-minute candlesticks for short-term reversals, especially in high-volume stocks and liquid ETFs. Daily and 4-hour charts were used for medium to large-cap trend confirmation, highlighting major directional swings. Let's zoom in on some key sector and stock highlights. In the technology sector, particularly high-cap names. Daily charts reveal bullish engulfing and hammer formations clustering in heavyweights. It's like NVDA and Meta. This supports a bullish technical interpretation for possible swing trades. If you've been eyeing these tech giants, now might be the time to make your move. The utilities and energy sectors, dominated by high-cap stocks, are showing hanging man and bearish Harami patterns on both daily and 30-minute timeframes. This suggests overvaluation and warns of potential pullbacks. Traders in these sectors should consider tightening their stop losses or taking some profits off the table. In the financials sector, doji and near doji patterns prevailed, with some banks experiencing strong support test levels on the 15-minute charts. This reflects indecision and potential volatility in the banking sector. Keep a close eye on financial stocks, as they may be primed for significant moves in either direction. Consumer and builder sectors are showing some promising signs. Hammer and bullish engulfing formations were evident on homebuilders' charts, especially the XHB ETF and AXP. These patterns are signifying short-term recoveries, which could present opportunities for bullish traders. Now, let's talk numbers. The technology sector led the rally last week with an impressive gain of almost 8% and a market capitalization change of $57 billion. Software and IT services sub-industries were the main contributors to the sector's growth, with increases of around 8% each. Meanwhile, hardware and storage had a weekly return of approximately 7%. Last week, the technology sector formed a bullish continuation candlestick, which is a positive candlestick pattern that shows the current uptrend is likely to continue. This pattern suggests that buyers are still in control and are pushing the price higher. In fact, the technology sector has shown strong momentum for quite some time, and it's possible that the positive trend will continue in the near future with the potential for new highs. Moving on to the basic materials sector, we observed moderate growth, with selected materials stock leaders like Newmont and Agnico, Eagle Mines posting strong gains. The overall sector market cap moved positively within the week, reflecting ongoing demand in core commodities and industrial resources. The basic materials sector saw a 3.8% increase, translating to a market capitalization change of $28 billion. A bullish engulfing pattern formed on Wednesday, indicating a potential reversal of the previous downtrend. Let's take a moment to discuss the sentiment and outlook based on today's candlestick analysis. Bearish sentiment is prevalent in the utilities and energy sectors, both with high capitalization. The high volume of bearish candlestick patterns in these sectors signals potential correction risk and overvaluation. Traders should exercise caution and consider hedging strategies for positions in these areas. On the bullish side, technology and communications sectors are attracting favorable candlestick setups and positive retail flows, particularly in small to mid-cap names. These sectors may be potentially undervalued, presenting swing entry opportunities for those looking to capitalize on bullish momentum. The financials sector remains mixed, with doji patterns reflecting market uncertainty ahead of macro announcements. This indecision could lead to increased volatility in financial stocks once the FOMC rate decision is announced. As we wrap up today's analysis, it's clear that the candlestick patterns for September 15, 2025, are painting a complex picture of the market. We're seeing elevated bearish reversal signals within large-cap utilities and energy sectors, which appear overvalued by technical standards. On the other hand, technology and communication sectors, especially mid and small caps, are showing undervalued characteristics supported by bullish reversal formations. Technical traders may want to consider short opportunities in heavy cap utilities and energy stocks while keeping an eye out for rebounds in tech and consumer sectors. Leveraging intraday patterns for tactical entries could be a smart strategy in this volatile environment. As we move through the trading day, keep a close watch on the candlestick patterns forming across different time frames. The 15-minute and 30-minute charts are particularly useful for identifying short-term reversals in high-volume stocks and liquid ETFs. In conclusion, today's market is a battlefield of bullish and bearish signals. With sector rotation and upcoming economic events adding to the complexity, stay nimble, manage your risk, and remember that in the world of trading, knowledge is power. Keep your eyes on the charts, your finger on the pulse of the market, and may the candlesticks be ever in your favor. Thank you so much for watching. I hoped this video helped you out. We will see you back here tomorrow. Before you go, please leave a comment. Smash that like button. Subscribe and click the bell to be notified when new content is available. The information presented in this report is intended solely for entertainment and informational purposes and does not constitute financial, investment, or trading advice. All opinions, analysis, and statements expressed herein are personal views and are not recommendations to buy, sell, or hold any securities or assets. Market data and any related commentary are provided as is and may not be accurate, complete, or up to date. Neither the author nor the publisher assumes any liability for financial losses, damages, or other consequences resulting from actions taken based on the information contained in this content. Please consult with a qualified financial advisor or conduct your own independent research before making any investment decisions. Investing in financial markets involves risk, including the potential loss of principal. This content is purely for entertainment purposes and should not be relied upon for any financial decisions.